If Washington and Tehran move closer to confrontation, your petrol price can jump even before a single barrel is lost. Here's why a US-Iran flare-up can translate into higher petroleum prices worldwide. First, markets price fear, not just supply. When traders think conflict is possible, they add a risk premium to crude futures. Now, that is why oil can rise sharply on headlines about strikes, naval movements, or deadlines in nuclear talks. Secondly, the Strait of Hormuz is the pressure point. Roughly 1/5 of global oil consumption and significant LNG volumes move through that narrow choke point. Even the threat of disruptions, harassment of tankers, or temporary closures can push prices up because alternatives are limited in the short term. Thirdly, shipping costs spike immediately in a war risk environment. Insurers raise premiums, tanker owners demand higher rates, and some vessels reroute or pause. That adds dollars per barrel to delivered crude, especially for Asian buyers, where most Hormuz flows end up. Now, these logistics costs filter down into petrol, diesel, and jet fuel prices. Fourthly, sanctions get tighter and supply gets removed on paper. If enforcement increases or buyers pull back, fewer Iranian barrels reach the market. Analysts model that even a 1 million BPT disruption can lift prices meaningfully, and a prolonged larger disruption can push benchmarks far higher. Finally, countries like Pakistan feel it because imported fuel is priced off global benchmarks plus shipping, refining margins, and currency moves. So when Brent jumps, the pump follows with a lag that depends on local pricing cycles and subsidies. Now, what is the bottom line? The bottom line is that US-Iran conflict risk raises oil prices through fear premiums, checkpoint disruption risks, higher shipping insurance costs, and sanction-driven supply losses. And consumers pay for all the above four mentioned.